Can I deposit a lump sum to start an IUL insurance policy? The quick answer is absolutely, but you must be careful because most agents do not understand how to structure it to accommodate a lump sum so that you do not incur more insurance costs the rest of the policy life unnecessarily. So stay with me for this episode. I think you're going to gain some insights into how to create an IUL policy to perform at its optimal net internal rate of return and to avoid a MEC the first year to accommodate a lump sum. You don't jack up the death benefit and leave it permanently like that. You should spread out that lump sum over several years. So get ready. I think you're going to be blown away with what I share with you. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower what I call their authentic wealth. My favorite financial vehicle, without question, is a property structured max-funded IUL, Indexed Universal Life. It's the only vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free, then be able to access that money income tax-free, turn on tax-free income that will last from age 65, 70 to age 120 at the best rate of return. And then at the end of the day, when you pass away, whatever you leave behind not only transfers income tax-free, but it usually blossoms. It increases in value. This is provided under Section 72E, 7702, and 101A of the Internal Revenue Code, respectively. Now, you can learn why on this channel, but many times when people come and they want to set up an IUL policy, or they go to a licensed life insurance agent, they'll ask, hey, could I kickstart my IUL policy with a lump sum deposit to get it going? Absolutely. But here's the biggest problem, okay? Normally, what the agent does is they submit the case to have an illustration created that's in compliance with Internal Revenue Service guidelines, okay? The Internal Revenue Code has guidelines, and so you have to have a death benefit that is commensurate with the amount of money you want to put into that. Now, the biggest mistake most people who are preparing illustrations make when they're trying to accommodate a lump sum, so let me give you a simple example, okay? Let's say somebody wants to start socking away $1,000 a month into an IUL policy, starting at age 35 or 40 or 45, whatever, and so $1,000 a month. Now, when you understand TEFRA and TAMRA guidelines, you're taking the least amount of insurance that you can get away with to put in the amount of money that you want to be grandfathered to put in without being obligated to, so that you get the best net internal rate of return, cash on cash. You want the cost of the insurance to be as low as possible, and you want it to become cheaper as you get older, okay? So that's an easy formula when you go, well, $1,000 a month is $12,000 a year. Now, you calculate, generally speaking, the first 11 years. Now, each insurance company is a little bit different, but generally you would times $12,000 by 11 years, which is $132,000. So that is what would be the guideline single premium. Now, that's the most you could put in if you took the minimum death benefit, if you solved for the minimum death benefit to accommodate $1,000 a month, $12,000 a year, and it would only calculate the minimum death benefit for the first 11 years. Now, having said that, you don't have to put in just, $12,000 a year for 11 years. You can put in $1,000 a month, the 12th year, 13th year, every year, the rest of your life. But you have to calculate during the first 11 years. Now, can you put in that $132,000 faster than over 11 years? Absolutely. When you calculate that for TAMRA, based upon your age, if you're over age 50, you could get that $132,000 in pretty much within 4.5, 5 years, so usually 5 payments. So 132,000 divided by 5, okay, is the fastest you could probably get it in and comply with what is called TAMRA, so that when you access money, it's income tax free. So you can actually put in the money faster, but no faster than TAMRA allows, which usually has to be spread out over at least 4 years and 1 day. Just think 5 relatively equal installments, okay? Now, you can put it in faster than 11 years, but you can't put in more than 132,000 during the first 11 years. So if you do maximum fund it and you put in 132,000 the first 5 years, you have to stop. You can't add another dime to that until the 12th year. And then you can resume putting in basically $12,000 a year every year thereafter. You don't have to put that much in, but you can't put in more than that unless you skip years that you don't put it in. You can make up for years you didn't put it in, okay? Now, here's where most people preparing illustrations make the mistake. If that advisor says, well, this client wants to kickstart his or her IUL with a lump sum. I don't care if it's $30,000, $50,000, $100,000 that is sitting in some bank or credit union earning a pathetic rate of return of 2 or 3%. Yeah, they ought to be putting that into the IUL. Or maybe it's a strategic rollout out of an IRA or 401k. You want to get the taxes over and done with sooner than later and put in the net after tax. Maybe you're selling a rental home that you're sick and tired of being the landlord, and you just want to get rid of that, and you put the equity from the sale of that rental into the policy. You maybe have an inheritance. It doesn't matter where it comes from, but if you have a lump sum of $30,000, $50,000, or $100,000, can you structure the IUL to accommodate it? Absolutely. But here's the biggest mistake. Most people preparing illustrations, they're just in there and they're going, oh, so the first year they're going to put in $1,000 a month, that's $12,000, plus $30,000 or $50,000 or $100,000. And so they go in and they say, what's the minimum death benefit that we need on this policy so it doesn't turn into a MEC, a modified endowment contract? Well, it's going to require way more insurance than you really need if you're only going to fund it with $1,000 a month thereafter. And so the cost of insurance is going to be way more than necessary. You have way more insurance than you needed. But I would say that 95% of all illustrations out there, whoever was running it is just trying to, what's the minimum death benefit to accommodate this lump sum? And then they jack up the death benefit, and that accommodated it the first year to avoid a MEC. But then after that, they're only putting in $1,000 a month. What's the repercussion? Well, at the end of the day, when I set up an IUL, I'm using it for living benefits. I want to have the best net internal rate of return. I want that after I fund it and it accumulates, whether it's 10 years, 15 years, 20 years, I want it to generate the highest net spendable amount of tax-free income, so that every $1 million, for example, can generate a 10% payout, which is what I've achieved for many, many clients, so that every $1 million can generate $100,000 a year of tax-free income. If they started at age 65 or 70 and it kept going until their age 120, okay? Now, you would be able to do that if you totally maximum funded it. But if you put in a lump sum and you jacked up the death benefit to accommodate that, then instead of earning an average return of 11 gross and a net of 10, you might earn 11 and only net 6 or 7. In other words, the costs are through the roof forever because you took out way more insurance than you needed to accommodate the one-time lump sum. So, first of all, you would ask yourself or the client, if you were an advisor, do you plan on putting in any other lump sums? Do you want to grandfather yourself for similar lump sums? And if they did, are those lump sums going to be that much every single year? If so, well, then maybe you do that. But most people, it's just a one-time lump sum. So in this example, if you're wanting to sock away $1,000 a month, $12,000 a year, and you have a lump sum of, $100,000 you want to put in, then you ought to spread out that 100,000 over the first 5 years. And so you would divide 100,000 by 5, so that's 20 grand. So now you would add 20,000 on top of the 12,000 for a total of 32,000. And then you take 32,000 and you calculate the minimum death benefit to accommodate 32,000 a year for the first 5 years. And then if you want to keep putting in $1,000 a month thereafter, you don't want to take out a new IUL policy, you've got to add another 6 years to the 11th year of 12,000. You add all that up, and that is the guideline single premium. Now you take the minimum death benefit based upon that amount of premium. The heavier amounts the first 5 years to avoid a MEC, and then also the subsequent years if you're going to keep putting in $1,000 a month, years 6 through 11. And so you add up how much money you're going to put into that during the first 11 years in this example, and then you calculate the minimum death benefit. And the fastest you ought to be able to put in a lump sum would be over the first 4 years and 1 day, the first 5 years. Now, sometimes, because you might be making room to be putting in $1,000 a month thereafter, you could get in that lump sum in the first 3 years or 4 years or 5 years. But see, you've got to be able to submit your case to somebody who understands TEFRA and TAMRA guidelines to avoid a modified endowment contract. What's a MEC? It means that your money grows tax deferred, but if you go to access money and you start taking out income, it's not going to be taxable. You want to avoid a MEC. Too many people, they just go, oh, I need to avoid a MEC, so I got to jack up the death benefit to this. No, you only need to increase the death benefit to this, and you ought to spread out the lump sum of 30 or 50 or 100,000, divided up over the first 3, 4, or 5 years. Does that make sense? So when you understand the dynamics of TEFRA and TAMRA guidelines, then if you wanted to have the best net internal rate of return, that if you gross, like I have, 11 and you net 10, you want to have the least amount of insurance you can get away with, okay? So that's why this is so critical. Can you put in a lump sum? Absolutely, I would recommend it. But you may want to spread out that lump sum. You may want to park some of it somewhere, or just take out like a fifth of it each year for the first 5 years, so that you can have the least amount of insurance you can get away with. If this sounds a little bit complex, here's what you need to do. First of all, you need to read my book, The Laser Fund. It's co-authored with my 2 sons, Emron and Aaron, to understand this even better. And you'll see examples of this in the book. And then you would need to make sure that a properly trained IUL specialist is actually designing and creating the illustration to accommodate a lump sum and letting you know how they should spread out that lump sum over 3 years, 4 years, 5 years, or whatever, to avoid the MEC, but also to get away with the least amount of insurance so this thing performs and you're able to earn the highest net internal rate of return. Otherwise, you're not going to achieve optimal results by having way more insurance than you needed, okay? We see hundreds, if not thousands of these every single year that are structured wrong. So click on the link below, go to laserfund.com, and when you go to that site, you simply contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. And then I'll cover the rest of that cost. I'll pay for the book. I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy of this 300-page book, if you like to listen and learn, there's audio versions. If you like to watch and learn, there's video. There's even an 18-hour master class. And you'll really understand this. But when you're in there claiming your free copy, if you want to attend some free educational webinars, we have 90-minute ones. We have 6-hour Retired by Design events. These are free. And you can even schedule an appointment to talk to a certified IUL specialist that will show you illustrations of how one is designed correctly to accommodate a lump sum, to avoid a MEC, but not have way more insurance than you need. And frankly, you may be shocked because just a normal illustrator might end up having twice as much death benefit as you really needed to have in order to have it perform optimally for you. Now, this is actually 2 books in one. This is the left brain side, 200 pages with all the charts and graphs. If you learn more by stories, you go to the right brain side, you flip it over, and this has 12 chapters with 62 actual client examples. And so this is not about me, this is about you and your brighter future. Check out this. If you're going to start out a policy with a lump sum, or if you're an advisor, it behooves you to make sure you understand this so that you are not doing your clients a disservice. So check it out. Make sure that if you're going to put in a lump sum, you do it so that it will be optimal all the way through the growth.